Welcome and thank you for joining us today for our webinar on Biz Finance and AR Cash Flow webinar. On the agenda today we've got two speakers, Frank Choi and Daniel Dunsford. Frank will impart his extensive knowledge gained from many years as a commercial accountant regarding the importance of finance to grow your business. And Daniel Dunsford from AR Cash Flow will then give you a demonstration on how AR Cash Flow can help you gain your finance to grow your business. Before we go any further, I just want to let you know that you'll be on mute during this session, but you'll be able to ask questions by typing in your questions in that pane on the right-hand side, then press send. Then both Frank and Daniel will answer these questions at the end of the session. Just a few words about CFO On-Call. We're a group of highly experienced commercial accountants. We've helped thousands of businesses just like yours with financial management, operational strategy, reporting, training and more. We take an operations view of your business, finding ways to improve your cash flow and bottom line. So today, the first of our presenters will be Frank Choi. Frank's a CFO On-Call partner and he's had considerable experience in many industries and is well qualified and ready to help business owners. One of Frank's specialties is helping small, medium-sized businesses grow, and he can assist with that growth by obtaining finance through Biz Finance. So thank you, Frank. It's over to you.
Thank you, Chanel. Good afternoon, everyone. Welcome aboard today. I'll talk to you over the next 15 minutes or so about the world of finance. Typically, we work closely with business owners out in the field, and oftentimes we come across situations where companies or business owners are looking for additional finance. Typically, these are businesses who grow very quickly or are in the process of starting up. But from time to time, obviously, established companies who are having working capital issues because of slow customer payments or having to pay for stock and so on. And cash flow issues typically come up. Sorry about that technical glitch here at the moment. As I was saying, the business owners who typically we come across are people who are growing their businesses and oftentimes a bit short of cash. Typically we come across companies who have facilities with banks which are fully committed. So let's have a look quickly at today's agenda, and we're looking at business owners who have problems getting finance, and we're looking at the importance, very important, of getting the right finance type, because if you get the wrong type, oftentimes you're paying too high interest or establishment costs and so on. And we look at a few examples of these. We look at the cost of finance and the opportunity cost of the different types of finance. Again, very important that when you borrow money that you get the right type of finance. And we look at some of the solutions available out there at the moment. Typically, business owners are used to dealing with banks, but oftentimes they don't realize or not aware that there's a lot of other finance institutions. These are not backyard operators. These are typically established companies in the finance field and offer a different product complementary to the banks. And we also look at how you go about getting, and we have a look at an example of a finance product, finance, and Daniel Dunsford will follow in the next 15 minutes. Okay, let's start with where you are at the moment. Typically, businesses, as you're growing, you're going to be short of cash because it's tied up with debtors or with your stock holdings. Certainly the prospects are good. A lot of people ask us at the moment, how are you finding the economy? I can tell you that, with the clients that we work with, and there's thousands of clients which CAD Partners, CFO On-Call work with at the moment. Most of our clients generally are doing well in the current environment, and we certainly help our clients to do well in their businesses. but a lot of clients, typically as businesses grow, the bank facilities are fully utilized, whether it's bank overdrafts or bank loans. And so typically businesses need more working capital to grow the business or to develop the business. For example, with startup businesses, oftentimes there's research and development or investment in equipment and so on. And whilst that's happening, our clients or business owners are often finding that there's still lots of opportunities out there for them. So they want to get the sales happening, but they don't have enough cash to finance the debtors or the stock in the meantime. So let's have a look at a few examples and the importance of getting the right finance product. The first example, company which I worked with, a manufacturer dealing with consumer products. This particular company had been or has been around for a while, an established business, and with new products, this company and the business owners found that suddenly there was huge demand for their products distributed through retail outlets, and they needed more working capital. At this point in time, we calculated we needed $500,000, but because typical of these things, this company's banking facilities was fully utilized. So we searched around and we found a finance source, which in this case provided funding for suppliers invoices, and the approval process or the application process was quite quick. The finance provider only required recent accounts and last year's tax returns. No property security required, and despite the bank facilities in place, we were able to set up this facility for $500,000. So typical of an arrangement like this, with the funding, it enables the company to purchase ingredients or products for its manufacturing and get the product produced, sold to the retail outlets, and then as the customers pay in 45 days, 30 to 45 days, that money goes off to repaying the $500,000 facility. This $500,000 facility is obviously a revolving facility, so as the borrowing gets paid down, then it frees up the amount available for reborrowing by this business owner. Moving on to the second example, in this case we're looking at an importing business, importing foodstuffs from overseas and distributing through local retail outlets and to restaurants. And this particular company needed $500,000, same as the last one. Typical of retail customers, oftentimes they're a bit slow in paying, but we had a good look at this business. It was solid. Similar to the last example, no property security required, and the application process took about 2 weeks to get approved. And again, as in the last example, no other requirements from the business owner. The debtors pay in 45 days, and the borrowings get repaid, and the credit revolves so that the credit is utilized for more to fund more purchases from overseas. The only difference about this particular example was the banks had a fixed and floating charge over the business, which is a security granted by the business owner over the business assets, and the the lenders required the banks to allow this borrowing to happen and take priority over the banks. Okay, the third example was actually the same manufacturing company. The first one, the business kept growing, and the business owner looked to buy more property for manufacturing facilities, and he found property not far down the road. In this case, it cost $700. And again, with the bank's facilities fully utilized, the owner had to go elsewhere. In this case, we found a low-doc loan. And in case you're not familiar with these, low-doc loans are basically typically provided by non-bank, non-trading bank lenders, and the approval process is typically based on looking at the borrower's accounts, at recent tax returns, and having a look at their trading forecasts. In this case, the interest rate was 11%, which is about 3% higher than normal commercial property loans. But because the business in this case study was growing so rapidly, the cost of the additional interest was far outweighed by the rapid increase in the growth and profitability of the business. So in this case, the loan was secured over the new property, and with the rapid growth in the sales and profits and cash flow of this business, the business owner was able to repay this loan, which was actually a 12-month loan. So important to keep in mind that property loans don't have to be sourced from the banks. And even though the interest rates are higher, if it gives you that opportunity to increase your profits and cash flow, then it's certainly worthwhile having a look at. Okay, the next example is a company which is in the field of renting out or hiring out earth-moving equipment and also selling the same equipment. This company had been established for a while, had quite a lot of borrowing with the bank. One thing which we quickly noticed was the bank overdraft was constantly around the $1 million mark. So when you have a bank overdraft and it's always near the limit, it just means that it's not the best way to borrow from the bank. And in this case, the bank was actually charging a rate of 11.5%, which is somewhat over the normal rate, which is about 10.5% or even 10% for secured overdraft facilities. So in this case, we looked at alternative banks, and ultimately we refinanced the whole facility with a new bank. And instead of having a $1 million overdraft, we replaced that with a $500,000 overdraft plus another $500,000 on bank bills. And the bank bills were actually at 8% compared to the overdraft rate of 11% or 11.5%. And in this case, it worked out that the annual savings would be around $30,000. The new facility, again, secured by property, not a problem. But most importantly, the business went on to save a lot of money with the new facilities. Last example for today is a company which is in the startup phase. This is a software company developing special software which is for companies for use on the web. And because the product was so good and it was getting a lot of sales in, it was important that this company was able to finance its software development. Because this company didn't have a long track record of trading and didn't have a lot of working capital and so on, what we found was the best way to source funds was to go and talk to private investors. There is an organization here in Australia called the Australian Small Scale Offerings Board, which is similar to the Australian Stock Exchange, but the requirements are much less compared to the Australian Stock Exchange. And typically what's required is information provided to the board, and also presentations to prospective investors. And what we did with this client was to prepare information including trading forecasts for the next 1 year or 3 years, plus also cash flow forecasts which the potential investors could look at. And the fundraising was successful. The initial fundraising was $500,000, and there is a prospect of raising additional $1 million for this client. Okay, so with all those examples, quite a range of examples and different situations. So just to emphasize the importance of looking at different types of finance. These are typically coming from non-bank lenders, and oftentimes it's easier than going to a bank because the banks usually are fully committed with their facilities with business owners. And as I mentioned before, even if the interest cost may seem a bit higher than normal, if you do have the opportunity to make increased profits, increased cash flow as a result of obtaining funding, and more importantly being able to service or repay that borrowing, then it's certainly worthwhile looking at different types of finance, even if they're at a higher cost. So the message here is to look at different situations and look for the best type of finance, and then go to market to raise the borrowings. These different types of finance are generally very flexible for the borrowers, and certainly somewhat less onerous in terms of providing security and so on. So if you're in the market to look for funds, and I must emphasize at this stage, it's certainly easier to borrow money if your company is doing well, you're making profits, you've got lots of orders coming through, because typically the lenders will look at that side of the ledger and make sure that the business is solid. Certainly, if you have any questions, do contact us at CAD Partners, CFO On-Call, for advice, and we're happy to come out and give you complimentary advice and look at your options and do an analysis of your business and prepare budgets and forecasts and so on. You may well be thinking at this stage, what about traditional bank finance? Yes, the banks are still there. We certainly work with clients where we refer our clients to different banks from time to time, or even talk to their existing banks or bankers regarding the traditional types of finance, as you know, vehicle, equipment, even property and bank overdrafts and so on. Typically what the banks want to hear is that you've done your homework. They want to hear a story that, that lending to the business owner is not going to be risky, and certainly that the business owner has a sound business and is able to service or repay their loans and interest. Okay, if you need some help, certainly come to us at CAD Partners. We've been working for many years with the banks and also with the non-bank finance providers, and also with various finance brokers who help us from time to time. Over the years, we've raised millions of dollars to help business owners. So we certainly can help you, find different lenders, certainly help you with doing the legwork, the preparation, the analysis of your business, and certainly the preparation of trading and cash forecasts. So feel free to give us a call, no obligation. As I mentioned, we'll come out and have a chat with you, and if appropriate, we'll do a complimentary business review. At this point, I'll hand you back to, or I'll hand you over to Daniel.
Thanks very much, Frank.
Okay.
Just trying to get logged in here.
I'll just give everyone a bit of an introduction to Daniel. Daniel's been helping small, medium-sized businesses grow for over 10 years, and he's a director and principal of AR Cashflow. The focus today is on providing cash flow solutions for entrepreneurial businesses looking to expand into new markets or trade out of precarious situations. Daniel started out his career in the Structured Solutions Group and the Commonwealth Bank of Australia before moving into equity capital markets at Credit Suisse First Boston. Thanks, Daniel. Off you go.
Thanks very much. Well, Frank's asked me to talk on the trade finance product today. we do three financial products here. We're a private financier, which means we don't draw our money from banks or financial institutions. Three products we have are trade finance or purchase order finance, port-to-port product, which is like a trade finance product, and also we do obviously the standard debtor finance and factoring. So today I'll just focus on the purchase order finance. So what is the purchase order finance? Well, purchase order finance is funding, obviously, to pay your suppliers. Just to run through these points briefly here, it's for finished products only. And what we like in purchase order finance is the products to be manufactured by a solid, credit-worthy manufacturer, sometimes locally in Australia, but mainly it's from overseas. At the moment, it tends to be China, where it's shipped directly to your customer. Now, that means it can't go via your warehouse. Sometimes it does, but we don't really like it to go that way. But in the circumstances where it needs to be picked and packed here in Australia, we usually send it to a third-party logistics provider. So why would you need purchase order finance? It's a good question, really. The best thing to do there is to just talk about a couple of examples of clients that we've helped. The most recent one we had was a client who was currently with the Commonwealth Bank of Australia. As everybody knows, they've wound down their debtor finance product. But even if they weren't being wound down from the debtor finance product, they were currently financing their cash flow for their smaller orders, and once products are delivered, they finance or factor those invoices, and then they use that to pay out their working capital requirements, office expenses and staff, and also to keep their suppliers up to date. But what you find happens with these rapidly growing businesses is they not only have to fulfill their run-of-the-mill orders, but they also get large orders come through from big distributors or retailers such as, for example, Myer or Grace Brothers. If that business was to use their existing debtor finance ledger to pull money out of and pay those suppliers, they would put their business under significant stress, which is what you find happens with these smaller businesses as they grow rapidly. If they can use another product that is funding not based just on their invoices for stock that's already been delivered, but also based on their forward order book, then that would relieve pressure on their existing day-to-day operations. So what we did with this business is we refinanced them from CBA. We financed their existing ledger, just like CBA was doing, but also their forward order book, we provided a facility against that as well. So we took their forward orders and we went to their manufacturers direct and we paid them for the products or financed those forward orders before they were turned into invoices. So generally the best types of businesses that we provide funding for, well, ideally they qualify for debtor finance first. If they qualify for debtor finance, then generally we can, and they've got a forward order book for finished products, we can also offer them the purchase order finance as well. Who don't we finance to? We don't provide purchase order finance to manufacturers. So if you have your own factory and you've got purchase orders or forward orders to companies such as BHP, but those orders are for finished product that you make on site, that's something which purchase order finance is not suitable for. You can use debtor finance once the product's been manufactured and delivered and accepted, but yeah, purchase order finance, it has to be third-party manufactured. The other people we don't provide purchase order finance for is it's obviously retailers as well. It's purely a wholesaler's product, or moreover, it's purely a distributor's product. So what are the benefits? Well, the benefits are you're not putting your existing business, as discussed before, under significant pressure, because you're getting these large unseasonal orders come through, or out of the ordinary orders come through, but you're not ripping the money to pay your suppliers out of your day-to-day operation. So you don't have that pressure, and that's one of that's the biggest piece of feedback we get from our existing clients, is it's just made such a difference to their business, not having to find the money to pay their suppliers before they can invoice it. The other benefit is for purchase order finance is if you're a new business or you're starting out and you can't get trade credit terms with your suppliers overseas, so they want to be paid prior to shipment, or FOB, freight on board. That's where there's a major benefit, because if you don't have a purchase order finance product, you really need to find that money between from the time when you have to pay for the shipment to all the way through to when it's delivered to your customer. So purchase order finance covers that period. Just going back to something that Frank discussed before, purchase order finance really is an opportunity-based product. If you were to compare it to a bank overdraft, well, it's not really competitive, but if you look at it in terms of you're using the product only to finance orders that you couldn't fulfill without it, then the cost becomes insignificant because of the margin. So let's just move on here to how does purchase order finance work. One of the biggest confusions I get is purchase order finance, yes, it is to pay your suppliers, but it's not based on purchase orders to your suppliers, it's based on purchase orders from your customers. So the first thing that we'll ask you if you are interested in purchase order finance is, can I have a copy of the work order or the purchase order from your end customer? The paperwork must absolutely be perfect. It's got to have quantities, delivery date, and totals on it. And it's got to be signed and executed by your debtor or your customer. So once we've got that purchase order, your supplier manufactures your goods. Now that throws up a couple of issues. If you don't have trading terms with your supplier's going to ask you for a deposit to begin manufacture. We don't pay deposits. The best way we've found for that to happen is for you as their customer is to negotiate that deposit with them, rather than us having to issue an LC prior to the manufacturing. And I'll get to why that's a good way to do it in a minute. So once they've manufactured the goods, we usually issue them a letter of credit to pay for the goods. At this point here, we like to issue the LC once the goods are manufactured. Now, it doesn't always happen this way, but we prefer it to happen this way because I prefer it to have it this way because we like to survey the goods prior to issuing the LC to make sure that the goods are actually being manufactured. There's not going to be quality issues. Chanel, I've got a couple of questions on here that have come up. Do I answer those along the way, or do you want me to answer those at the end?
Well, if you're comfortable, you can answer them now. I can see one there. It says, can I finance services? Yep. Yes. For example, insurance, legal fees, and so on.
That's a really good question, because you can and you can't. You can finance services that are directly relating to that order and getting that product from your manufacturer through to your customer. So that would include marine cargo insurance, shipping, So yeah, any of freight logistics, GST, but it doesn't cover working capital. So we don't allow drawdowns against a purchase order. We've had some clients come through and they say, yeah, we've got an order from, say, for example, Woolworths, but we've got some costs we need dispersed along the way, but they're not relating to the order. So as long as they're relating to the order, generally you can. I'll just go to the next question I've got here.
Yep, it's
if you've got a bank, yeah,
yes,
go on.
yeah. So Frank's asked, have I, if a bank overdraft, do I need advice from my bank that I'm borrowing elsewhere for my business?
Do you need to advise your bank? Well, that's up to you. It's generally we recommend it because it's best to run an open book policy. You don't want them having any surprises. If they have a fixed and floating charge over your company, which they generally would, you will need to advise them because we need a release over the inventory because we're financing inventory effectively, and we need a release over the debtor once the stock lands. And I'll get to why that is in a minute in the process of it, of how it all works.
Thank you,
So just
Daniel.
go back to our chart. You're welcome. We issue a letter of credit when we're sure that those products are sitting there on the factory floor and ready to be shipped. And I'll tell you why we do that. We use a third-party surveyor or inspector to go in and check the goods. We'll either use Intertech or Inspectorate or SGS, one of those companies that do it globally. If we issue the LC prior to the goods being surveyed, and we put the LC out the door, usually that letter of credit's either going to be in US dollars or pound sterling or euro or something like that. Now, that exposes both us and the client or our client to foreign exchange exposure, because if the survey on those goods fails prior to loading, we've got to unwind the transaction because that factory may not be able to make good on the issues that we have with the products. So that's why we don't always do it this way, but it's recommended that you pay the deposit. Once the goods are ready to be shipped, we survey the goods, then we pay by letter of credit, and usually the LC is subject to our survey, insurance, and also the bill of lading when they're shipped, put on the boat. So moving along. So yeah, your goods are then shipped directly. Once they're put on the boat, they go all the way through your customer. When they land at the customer's premises, their DC or wherever it's going, you as the client send the customer a copy of the invoice as normal, and you send a copy of the invoice to us. Now when you invoice that customer, it's got to have our payment details on it because we need to close, once it's delivered, we need to close out the trade finance component. We usually do that by financing that invoice because usually large credit-worthy debtors require trading terms, and once it's delivered to their warehouse or their end factory, that's no longer trade finance or purchase order finance, it's now factoring or debtor finance or invoice finance or discounting, depending on what you want to call it today. So, and that's, but once it's delivered, that effectively closes out the purchase order finance. Just go to the next slide. So what's required of you as a client? Well, we require a fixed and floating charge over the company, personal guarantees. These days, if there's property, we'll take second mortgages on property. I mean, it's just that tight out there at the moment for capital from entrepreneurial funders like us that we really want to wrap you up to make sure that we really want clients that if there's a problem with that stock and it gets delivered to that customer and they for some reason don't want to accept the goods or the goods don't work or they're not what they're ordered, we want to make sure that our client is motivated to make good on that transaction, deal with the factory, do whatever they've got to do. I don't want to be the one who has to be going down to the customer, liaising with the factory, making sure that that order is fixed up. So we want, although we don't really require dollar for dollar collateral that the banks require, we still want to make sure that our client is financially motivated to fix up the transaction, is not going to jump on the next plane back to the UK. Yeah, so fixed and floating, personal guarantees, second mortgages on property sometimes, and the other thing that's required is the way we close out our transaction is we put a debtor finance facility in place. before we finance the order, we take an assignment over that debtor, so that debtor signs off on the order and they're directed to pay us instead of pay you. That's, sometimes clients say that's a bit harsh, but the reality is that actually protects them from us having to collect from them and making sure that the transaction flows through smoothly. We just want it to roll seamlessly. So some of the things that we do, and not always, but generally we'll do, is we'll do a factory review. So our biggest risk with these transactions is that the end debtor, the customer, opens up a purchase order, but then for some reason cancels that purchase order halfway through, in which case we're pretty much just out of luck. Or, well, that's scenario A, the worst case, or B, those goods get to the end customer and that they're faulty or they're not what they ordered. So before we approve a deal, we'll usually do a factory review. So we'll send in an auditor, if it's in China, for example, and they'll go through the factory and make sure that they're capable of producing the products to that spec. That's not a panacea or a silver bullet, because we've done factory reviews before. They've manufactured the goods and then they fail the survey, and then we have to cancel the order altogether. So we'll look at other things like, have you dealt with them before? How many times you've dealt with them? What are your trading terms with them? Who else do they manufacture for? Yeah, so that's why we do a factory audit. It's saved us and saved our clients many times. So after the factory audits happen, yeah, then we generally move to the next point, which is auditing the purchase order. So I'm moving on to the checklist now. These are the things we need in order to put the purchase order finance in place. Copy of the purchase order, supplier agreement. This is one thing which we haven't talked about before, enough margin to make at least 30% profit. We really won't consider transactions where there's less than a 30% gross margin that's above the line in delivering the product. So if my landed cost is $70 to the end customer, once you pay out everything, we want you to be invoicing them for net $100,000 if it's to retail. So you've got a 30% margin in it. If you don't have that margin, it doesn't affect our pricing, but we would say that it's a little bit too risky for us. We'd say you're too risky as a client. The next thing, experience in dealing with the type of exchange. This is critical. And we have to do it even with experienced clients, is in obviously training up in the way we like things doing, that we like things to be done, and also working obviously in the way with the way they want things done. But if the client is a newbie and is a greenhorn at what he's doing, we really don't want to be teaching them, holding their hand through the foreign exchange risks and making sure they've got a purchase order, those sorts of things. We really want to make sure that the clients have got experience with that stuff before, and also that they've dealt with the factory obviously overseas. And the detailed factory review is the next thing. We've already sort of dealt with that. Now I'll open it up. That's pretty much all I want to say. I'll open it up to questions.
Okay, Daniel, there's...
So I'll just go back to some of these questions here.
Yes. Yep, I was just about to ask you. Yep. Julie's asked, what are the costs of your facility, re-establishment and interest?
Yeah, look, that's a really good question. We really are a bespoke financier, which means every single facility that we do is very, very different, and our pricing moves around a lot. Our pricing moves around a lot depending on the risk of the transaction, how long the relationship's going to be with the client, like how many transactions they want to finance. We don't do short-term deals where the client wants to come in and say, oh, I want to finance one order. We want at a minimum of a 12-month contract with the client, so we want to know they're going to do this every couple of months for the next 12 months, because to do the first order, it's a lot of work on the trade team here to get it in place. And once we've done it once, we want to be able to capitalise on that by doing it a number of times. So the cost of the facility, look, I don't know. We don't charge interest. We're actually a discounter, so we discount the order. So we'll levy a fee on the order. So we'll say we might charge I don't know how many points, but there, and then we'll discount the order for every day that it's on foot that we've got money out the door. And money out the door means we've issued a letter of credit. Some clients think that because we've issued a letter of credit and the end supplier, supplier overseas hasn't got the money, that we haven't put money out the door. But you go to the bank and try and issue a letter of credit and not put any collateral up. So from the minute we have to issue lodge collateral with the bank, which is basically what we do, we basically go to the bank. We use Westpac most of the time. We go to the bank with a whole pile of money and we put the collateral up instead of you having to do it. That's really what we're doing. So yeah, look, establishment costs, usually, you know, there might be standard stuff, legals, which are, you know, I don't know, they might be anywhere from $1,500 to $3,000. You might be charged a line fee, you know, to audit your outstanding invoice ledger. If there is one, there isn't always a decent ledger. But look, you know, in terms of our setup costs, we're competitive with most normal debtor financiers. The trade, you know, look, it's probably a bit, the best way to price it is probably a little bit more expensive than an overdraft. But if you had an overdraft, you would probably, it's not really right to compare it to an overdraft, because if you had the overdraft and it could do the job for you in terms of funding that order, then you'd be using it. But if you don't have those credit lines in place, or you're already up to your limit with the bank, then I'm not sure what you'd be comparing us to. Equity, you know, which is superhumanly expensive. So our cost is a fraction of the cost of equity. We don't have any control over your business. You know, at the end of the contract, you just say thanks, but shake hands and move on if you don't have a need for it anymore. Hopefully you do. But yeah, look, it's a little bit more expensive than an overdraft.
Okay.
Are there any ongoing facility fees?
Yeah.
We usually charge an annual fee on our debtor finance, like everybody does. So whether you use it or not, you pay that annual fee, which is usually a monthly fee. But if you're financing invoices all the time, then you usually make that up. You don't have to pay it. Should I get foreign exchange contracts for it? Yeah. So actually, Frank, that's actually a really good question. The question is, do I need, or should I get foreign exchange contracts for my imports to cover FX risks? We don't take foreign exchange risks. So we won't, if we're issuing a US dollar letter of credit to a supplier overseas, we will not issue that LC until your customer has signed off on that particular order that LC is for. So if you know that you've got a supply contract that over the next 12 months you're going to need to supply, I don't know, BHP, something, steel, you can still go and get your FX contracts. You just go off and do that on your own with the bank. They'll probably ask you to lodge collateral for it, like they would ask for the same thing. But yeah, as soon as the purchase order is confirmed and we want to do that LC, we're in a position to finance it, we will do the foreign exchange at spot. We will put the money on security in US dollars with the bank in a foreign currency term deposit until that LC is drawn upon. So it's up to you. If the currency moves around after that, that's done. We do the FX on the day. That's it. I'll just move down here. What I do if we want to source finance from you should be called CFO On-Call. Yeah, definitely give Frank a call. Whether you go direct, you're probably better off going to Frank than coming direct to us, because Frank will assess whether it actually is a deal going for us through us, or there might be a better way to do it. Whether you go through CAD Partners or not, you know, it doesn't cost you any extra to go through them, so you may as well just go through them, and then at least you know you've got all your options, rather than coming to someone like me and I'm just going to tell you yes or no, we can do it or not. You know, you're better off working out whether it's the right way to go first. And we're happy to work with, or we do work with Frank on that side of things as well. Would we lend both products, debtors and trade finance, to a borrower, or would you fund the borrower's customer? That's a good question. Generally we do both. So you would finance your debtors first. If you can't get enough working capital out of there to finance your orders, then you would use the trade facility as well. So our trade facility has no lock-in contract. You only pay for it when you use it. The catch is you have to be doing debtor finance with us first. So you may as well use the debtor finance. It probably costs, usually it's about half the cost of trade finance. So debtors is always a better way to go. And it's a lot less work for you and for us as well to put that in place.
Great, Daniel. I've still got a few more questions here for you. One's from, okay, Marie says, can you do a back-to-back letter of credit?
Yeah, look, you get this question once a month. Generally, you can't. I'll tell you why. It's a seriously risky thing for a financier to finance, and that's why they don't do it. Because what happens is you get an LC from the buyer, and then they want, we get the client come through and they want us to issue an LC against that LC. Now, what you find happens is, this is where the financier goes down, is that the supplier who we've issued the LC to, for some reason, can always satisfy their LC. But then if we go to cash the LC on the other side, we always find that you can't cash that LC. There's always some discrepancy. So you end up paying the supplier, you can't cash the buyer's LC, and the financier does their dough. So that's why we won't do it. The only time we do it is if you've got an LC from BHP or Rio Tinto or someone who is seriously high grade, and we know they want the stock, and we know that they're going to make, if there's a discrepancy in the LC, they're going to fix it up. So yeah, we don't do it.
Great. So how do you pay suppliers if they are overseas?
Generally we like to do it by LC, but it's either usually by TT or LC.
Okay. Okay, so once you've paid my suppliers, where do the goods get delivered to?
Well, if we're paying by LC, they'll ship it and send our bank the bill of lading. We'll get the bill of lading here in the office. And if we wanted to go direct to the customer, we'll take an assignment. We'll get your freight forwarder to give us an assignment of the goods, as well as your logistics company, that they give us an undertaking that they will deliver those goods according to the order instructions that we give them, which is usually the purchase order from the end customer. So they can go to your warehouse here if you want. We'll want a lot more collateral. Can you hear me all right?
Okay. Yes, I can. Thank you. And also there's another question from Joe. He's asked, what if goods are delivered and the customer changes their mind?
That's where you're out of luck. That's a very big risk, yep. And it does happen. But yeah, look, if you've made a whole bunch of I don't know, Kevin Rudd t-shirts and we're delivering them to the to Woolworths, and they get there and they don't want them, you're stuck with that particular product. Look, they really, if they order it, they usually want it, but yeah, most orders are cancelable. Yeah, it is risky, and it can and does happen.
Gosh, I've got a question for you, for Frank, from Jody. Does my company need to provide any security for the facility?
That's a question for me.
That's for
From Frank.
Yeah.
Oh, okay. Go,
right.
Daniel.
From Frank to me.
Yes, yes.
Yeah. Look, these days, yeah. I mean, look, like I said, fixed and floating, personal guarantee. If they're doing trade finance with us, we want to know. We do like them to be property owners. Having said that, we've got a lot of deals that they aren't, but we want to know that the client is grounded here in Australia and they're motivated to fix up any issues we have.
Okay. And Daniel, how do I get a supplier approved for production or manufacturing of my goods?
We just do a factory review. We want to know what you've done to make sure that they're legitimate. Have you been over there? We see photos of the factory, but we can do due diligence on it and a factory review, but at the end of the day it's up to you. If this thing, even if we do a survey on the goods and they get here and they're faulty, that's not our problem. We recourse that straight back to you, and you've got to somehow make good on it.
Fantastic. Well, we've come to just the closing moments of our webinar, and so thank you so much, Daniel, for your participation. It's been great, and thank you to Frank. But just before we wrap up, I'd like to mention to you that CFO On-Call have a great offer for you today. If you'd like a free 1-hour consultation with Frank or a CFO On-Call advisor, please call Laurie on 1300 36 24 36, and that's if you're in Australia, or 0800 180 400 if you're in New Zealand. You could also mention to Laurie that you'd like a copy of our free new book, The 7 Key Numbers That Drive Profit and Cash Flow. It's a fantastic book, easy to read, and I'm sure all business owners would benefit from receiving a copy of this book. So thank you very much, everybody. Thank you for attending our webinar. If there's a topic that you would like us to cover, or you've got any great feedback for us, we'd love to hear it. And so thank you again. So on that note, I will wish you a great day, and we'll hopefully see you soon.